Okay, so factory overhead, again, cannot be perfectly allocated. Depending on where the balance falls at the end of your year will determine if your overhead has been over or under applied. All right, so on the debit side, this is actual expenses. This is what I've actually paid out of pocket for utilities and everything else. If I have allocated based on my estimated predetermined rate, I've allocated out to all of my jobs. At the end of the year, if I still have an amount in overhead on the debit side, that means I have expenses that I paid for that did not get applied to jobs. Right, so I under-applied, I underestimated. So I have a bunch of expenses still sitting here that didn't get attached to a job. If the reverse is true, let's say I overestimated, then I will end up with a credit balance in my manufacturing overhead account. If I have a credit balance, then I have allocated a little bit too much overhead costs to my jobs, right? More costs than I actually came out of pocket for, right? Then I have an under-applied overhead. And no matter how perfectly you try to estimate, at the end of the year, you will always have something. You're either going to have a debit or a credit balance in manufacturing overhead. That's just the way it is. All right. So going forward next year, you learn from that and try to get a little bit better estimate. It happens. It's just part of the way things go. All right, so here is our factory overhead account for Legend guitars that we're going to look at. And it's going to show both sides of factory overhead, under applied and over applied. So here we are at December 1st. We have a credit balance that has come forward from the beginning, or left over from November. So at the end of November, I had a credit balance in my overhead account. December rolls around. I have some actual expenses that have come in, and I've allocated, right, here's the debit, there's the expenses that I paid. Doesn't tell me what exactly, but my utilities and whatnot. And then December 31st, I applied my overhead costs to the jobs that were still in process in December of $42,500. So now, December 31st, the end of the year, I've got a $150 debit balance. All right, so throughout the year, this overhead is probably going to bounce back and forth depending on your estimate, and sometimes extra factory costs will pop up that you weren't aware of. It's impossible to predict everything. So the only balance you really care about is what you have left at the end of the year. I have $150 left in my overhead. That $150 technically should have been applied to every single job that was completed or worked on during this year. But I'm not going to go back and recalculate every job so I can stick a couple of dollars to each job to get rid of that $150. All right, so here is, we'll go through this. Probably should have come later, but that's okay. I will also encourage you to put this on pause for a minute and try to get through parts A, B, and C on your own and see if you understand it before you come back Okay, so Hatch Company estimates their total factory overhead for the coming year will be $100,000. All right, that's the total factory overhead expenses that they think they are going to pay out. They use direct labor hours as their activity base, and they are estimating that they are going to use 25,000 direct labor hours in the coming year. All right, so those again are their estimates. So for Hatch Company, what is the predetermined overhead rate using those estimates that we were just given? Once you have determined that predetermined overhead rate, you should be able to figure out how to allocate the overhead to jobs 1 and 2, jobs 101 and 102. From example exercise, well, that shouldn't be 19.2. I think that should be 17.2. Let me see if I can find it here, because that is going to be a problem. All right, it is, yes, it's example exercise 17.2, and I will tell you right now, job 101 has 800 hours. Job 102 has 600 hours. So 101 has 800 hours, 102 has 600 hours. And then once you have calculated how you're going to allocate, what is the journal entry? All right, so the first thing, let's look at the predetermined overhead rate. We're using direct labor hours as our activity base. For this coming year, I'm estimating I should have total factory overhead, total actual costs of $100,000. I should have total direct labor hours of 25,000. So my predetermined overhead rate formula, my estimated cost divided by my estimated activity. So 100,000 divided by 25,000 hours is going to be $4 an hour. All right, so that is my factory overhead rate, $4 an hour. So job 101, I said, has 800 hours. I better look and see if this is different. There it is. Job 101 had 800 hours of direct labor used. So if my rate is $4 per direct labor hour, job 101 used 800 hours, therefore $3,200 of overhead cost will be allocated to job 101. Job 102 used 600 hours times that $4 per hour rate. $2,400 of overhead will be allocated to job 102. So $5,600 of overhead. Remember, we were estimating total overhead of $100,000. I've already allocated $5,600 between these two jobs. So I'm going to credit my manufacturing overhead account for this estimate. And remember where it goes, right? Work in process, right? Because work in process accumulates my direct materials, direct labor, and overhead. All right, so during the year, that factory overhead account balance is carried forward. And again, it's going to bounce around between debits or credits. However, at the end of the year, manufacturing overhead should be zero. We don't want any balance carried over into a new year because our overhead costs apply to only that year. Those expenses apply to that year. We want to make sure those costs stay in that year. So if we have anything left in here, and again you will, whatever you have, whether it's a debit or a credit, we want to zero this manufacturing overhead account out. So if I have a debit balance left where I've underapplied my overhead, I'm going to credit overhead to make it 0. And the journal entry where I'm going to apply that is cost of goods sold. Because had I been able to perfectly allocate everything, that's where it would all end up, in cost of goods sold. And again, the reverse is true. If I have a credit balance, I want to zero this out. I will debit manufacturing overhead for whatever balance is in here and close it out to cost of goods sold. So whatever's in there, get rid of it and shove it in your cost of goods sold. So there we are. If it's underapplied, credit overhead, debit cost of goods sold. If it's overapplied, debit overhead, credit cost of goods sold. All right, so clearing out your factory overhead, again, it doesn't matter what your balance is, whether it's been overapplied or underapplied, just get it out of there. Zero out that manufacturing overhead or that factory overhead and zero it out to cost of goods sold. And I think that is it. Oh, back for legends, remember what we had left in there? We had $150 sitting there at December 31st in our overhead balance. It was underapplied. So I'm going to debit cost of goods sold for $150, credit factory overhead for $150, and I will have $0 left in factory overhead. I will start the new year 2017 with 0 in my factory overhead, and I will come up with a new estimate for my predetermined overhead rate to use in 2017. And that is it. I hope that helped a little bit. I'm going to be working out a problem that will hopefully help you analyze all of this as well.